We all love a great deal, and when that deal is an awesome total return stock for under 15 bucks, sign me up. Hold on to your seatbelts, folks. This is going to be a good one. Primarily, I am a total return investor. I do have a sweet spot for passive income stocks, but when push comes to shove, the total return stocks are the dominant focus of my portfolio. There are a lot of great total return stocks out there, and I have more than a few of them in my portfolio. However, many of them are quite pricey, and sometimes, especially for newer investors, it can be nice to find some cheaper ones. Of course, seasoned investors know that often those cheaper stocks grow into, well, the more expensive ones. And that's a ride I'm always looking forward to taking for sure. If you look at Hammond Power Solutions with ticker HPS.A, they are listed at $95 at the time of recording. And just, 2 years ago, guess what? They were a under $15 stock. Of course, not every stock will follow the same trajectory, and there is never a guarantee that any of these stocks today will be worth, $100 in 2 years. It is not impossible, but for most companies, it is also more than likely not going to happen. What we do know is that these companies we will be looking at in a few moments are moving in the right direction, and their past returns are proof of that. The only investment I know of with a 100% guarantee of a return is, a subscription to this channel. Before we jump into today's stocks, I do want to quickly break down the qualifiers I used for making this list. The obvious one is that, the stocks need to be at $15 or less. Otherwise, I'd have to go back and change the title. I also only looked at stocks that were more than $5, as we want to keep the penny stocks out of this list. Don't worry, I will eventually give those penny stocks a chance to shine, just not today. I also eliminated any stocks that have not performed in the positive by at least 10%. On their 3-year, 1-year, and year-to-date returns. I also insisted that they have a dividend yield of at least 0.1% or better. Finally, I wanted a return of equity of at least 10%. A good ROE can go a long way towards giving me some confidence in their future performance. Today's list is sorted by their year-to-date total returns. So without any further ado, let's do this. Kicking off this list, we have a community favorite with Hammond Manufacturing and that very familiar ticker of HMM.A. They are based out of Guelph, Ontario, and they design, manufacture, and sell electrical and electronic components. Their product range includes electrical enclosures, racks and cabinets, power distribution units, small enclosures, and electronic transformers. At the time of recording, their price comes in at $9.51. Their market cap comes in at $107.79 million. They are much less volatile than the market average with a beta of 0.62. They have an earnings per share of 1.68, and their PE ratio is coming in at 5.66. That return on equity, that's coming in at 20.15%. And the return on assets, that's coming in at 9.59%. In terms of debt, their debt-to-equity ratio, that's coming in at 53.35%. Looking at their dividend, they do have a yield of 0.631%. It's a semi-annual dividend, so twice a year, of 3 cents per share. The payout ratio on that, of course, it's super sustainable at 3.57%. Looking at their returns, on the 3-year return on investment, that comes in at 154.28%. Add in the dividends, their total return 158.82%. On the 1 year, that return on investment comes in at 61.19%. Total return after we add dividends, 61.20%. On the year-to-date, their return on investment, that comes in at 15.98%. Factor in the dividends, we get a total return of 16.34%. This is a stock that did explode in the last year, and currently we are down a lot from their all-time high. However, I do feel this correction will be good for this stock. Coming in at number 4, we have BioSyent Inc. with a ticker of RX. They are based out of Mississauga, Ontario, and they are a specialty pharmaceutical company that focuses on the development and marketing of pharmaceutical and healthcare products. They are known for their iUGO Care platform, which supports complex chronic disease management and telemedicine solutions. Their price, that comes in at $10.50, and they have a market cap of $121.64 million. Their beta, pretty average, coming in at 0.95. Their earnings per share, that comes in at 0.58, and they have a PE ratio of 18.10. That return on equity, that's coming in at 20.75%. And the return on assets, 12.94%. I am liking their debt, as we have a debt to equity ratio of 3.40%. Their yield, that comes in at 1.714%. It's a quarterly dividend of 4.5 cents per share. Payout ratio on that comes in at 28.21%. Looking at their returns on the 3-year, their return on investment comes in at 30.76%. Factor in the dividends, we get a total return of 34.37%. On the 1-year, 43.84%. Factoring in the dividends, 46.16%. Looking at that year to date, 16.41% return on investment. That total return, 16.34% after we factored in those dividends. This is a company that has been working hard to expand their product lines and entering, of course, new markets. It should go without saying that this is a prescription for continued success. Taking our third spot, we have Dundee Precious Metals with a ticker of DPM. They are based out of Toronto, and they are an international mining company engaged in the acquisition, exploration, development, mining, and processing of precious metals. They focus on gold and copper production, leveraging advanced technologies and sustainable practices to maximize efficiency and environmental responsibility. Their current price at the time of recording comes in at $10.85. They've got a nice looking market cap, $1.97 billion. Their beta, they're a little more volatile than the market average. That beta is coming in at 1.21. Earnings per share, 1.33, and they have a price to earnings ratio of 8.16. Their return on equity, that comes in at 16.18%. They have a return on assets of 8.75%. And here is another company with very little debt and a debt to equity ratio of 1.20%. That's not too shabby. Switching to their dividends, their yield comes in at 2.017%. It's a quarterly dividend of 4 cents USD per share. The payout ratio on that comes in at 16.49%. Moving to returns, that 3-year return on investment comes in at 43.90%. Add in the dividends, we get a perfect 50% total return, not too shabby. On that 1-year return on investment, that comes in at 22.88%. Total return, 24.69%. And finally, their year-to-date, that return on investment comes in at 26.90%. Adding in the dividends, we get a total return of 28.30%. This is a company that has, well, they've done well, even when the sector was struggling, and that does say a lot. In fact, many analysts have predicted a 1-year price target for them of $14.22. So that's a 35.43% jump. So that may be something to look forward to. In our almost top spot at number 2, we have Medical Facilities Corp with a ticker of DR. They are based out of Toronto, and they own and operate specialty hospitals and ambulatory surgery centers in the U.S. Their facilities offer a range of non-emergency surgical, imaging, diagnostic, and pain management procedures. Their price at time of recording comes in at $12.74. They have a market cap of $311.76 million. Not a lot of volatility with this one, a beta of 0.49. Their earnings per share come in at 0.86. They have a price to earnings ratio of 14.81%. That return on equity, very nice looking 38.26%. Return on assets, once again, pretty nice looking 12.45%. They do have a little bit of debt, and their debt to equity ratio, that is coming in at 99.96%. Switching to their dividends, they do have a yield of 2.826%. Quarterly dividend of 9 cents per share. Their payout ratio on that comes in at 38.13%. Looking at their returns on the 3-year, that return on investment comes in at 78.18%. Factor in the dividends, we get a total return of 91.75%. On the 1-year, that return on investment comes in at 58.26%. Factoring in the dividends, we get a total return of 62.40%. When we look at their year-to-date, they have a return on investment of 42.35%. Factor in the dividends, we get a total return of 45.16%. America is a for-profit medical environment, and this Canadian company has been gobbling up those U.S. profits like, well, Pac-Man. I suspect they will continue to do well, especially as the demand for medical services stays, and actually it may increase as the boomers retire. In our top spot at number 1, we have CES Energy Solutions with a ticker of CEU. They are based out of Calgary, and they provide consumable chemical solutions specifically for oil fields. They do have products for all aspects of the oil field life cycle. Their current price at time of recording comes in at $6.77. They have a market cap of $1.59 billion. They are more than twice as volatile as the market average with a beta of 2.40. Their earnings per share come in at 0.71. Their price to earnings ratio, that comes in at 9.54. And their return on equity comes in at 26.28%. That return on assets, 10.73%. Their debt to equity ratio, that comes in at 60.16%. Switching over to dividends, they do have a yield of 1.773%. It's a quarterly dividend of 3 cents per share. The payout ratio on that comes in at 14.79%. Their 3-year return on investment, that comes in at a really nice looking 243.65%. Total return after we add in the dividends, 256.60%. On the 1 year, it's still looking pretty good with a return on investment of 178.60%. After the dividend, we get a total return of 183.13%. On the year to date, that return on investment comes in at a holy banana bread level of 94.54%. Factor in the dividends, we do get a total return of 96.98%. These numbers are fantastic. And really, you have to be wondering if they can keep it up. Well, according to most analysts, they are expected at least another 25.11% growth in the next year. In the past, they have demolished every little expectation the analysts have laid out like this, so they could absolutely crush that. If you are interested in any of the bargain stocks we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on growth ETFs, and I will see you in the next video.